So without wasting much time, let us move forward with the session for today. So good evening, everyone. Financial year has just ended, and we'll be starting a new financial year 2025-2026. And we are going to discuss that in this today's session about the market outlook for FY 2025 and 2026. What is that lies ahead over the next 1 year and how to position ourselves. With data, facts, and figures, we'll be discussing about each and everything. So let us go forward and understand. Hope everyone is able to see the screen. Now, market outlook for next 1 year, and this is the market outlook which, based on various facts and figures, we have came up with. And at the end of this session, I'll be also talking about the strategy, how we are playing it with this market outlook. First, I'll be discussing about the market outlook. Then I'll be showing you why this market outlook is there based on the data. And at the last, I'll be talking about the strategy to play out this market outlook, whatever we are having. So let us first understand that about banking and financial services index. First is banking and financial services index is trading at 16 times earnings compared to market PE of 24 times. We might be seeing that market price to earning at 21 times based on consolidated earnings, but based on standalone earnings, market is still trading at 24 times, which in no mean it is will be called as cheap valuations. So banking and financial services index, especially financial services, more than banking, the high growth is in financial services. So banking and financial services put together is trading at 16 times. So precious metals, we are in a bull run at least till 2028. We have discussed this in commodity bull run session. Even in the gold mining session, we discussed about it. Even in the precious metals miners session, along with that silver session, we discussed about it. That at least till 2028, there will be a precious metal bull market. And silver outperforms gold in a precious metal bull market, and silver has not done anything in this overall precious metal bull markets. Gold has touched 3011 to 3100 USD in dollar terms, prices in dollar terms, but silver has not moved much. But silver is at an inflection point, and what expected price for silver is 50 USD currently, which is trading at 34 USD. In Indian terms, it will be like 1.5 lakh rupees per share per kg. And silver is deeply undervalued. If you have not gone through my session on silver, it is available on YouTube. You can go through that. Silver, big breakout ahead, big rally ahead. I have taken a special session on that, which explains in detail why I'm saying that simply silver is deeply undervalued. So allocating to silver makes sense. Chinese markets are expected to outperform Indian equities. They have already started outperforming Indian equities. They are relatively undervalued and showing high relative strength versus the market, which means in the falling market, Chinese market might fall less. In a rising market, Chinese markets can rise better than Indian markets. That is what the situation is. And this outperformance can continue over the medium term. Along with that, the next outlook is we are in a commodity bull run since April 2024. We have seen most of the commodity prices have started moving up. Precious metals outperform first, then industrial commodities, then along with Chinese stimulus. Chinese economy has been stimulating because of government interventions, and we might see robust commodity prices going ahead. So that is one outlook. Then next outlook is regarding equity as an asset class. So equity as an asset class itself is unfavorable. At least for next 6-8 months, it is going to be unfavorable. And why is it so? I've talked about it in earlier sessions also. So the tensions, the global power shift, what it is happening, and the overall rising tensions around the globe, and the valuations where the markets are. We are not at a position wherein we will say that equity is the best asset class. Equity is unfavorable, but looking at all this data and facts and figures, and it is also evident from the data which we will be talking about at a later stage. So need to play on back foot. That is what the outlook is, by owning undervalued sectors, showing relative strength versus the markets, with a mix of lump sum and weekly staggered buying to better average it. because time correction can play out, showing broader market underperformance. And the way to mitigate time correction is by going slow in the accumulating phase. So when you go slow in accumulating phase, you also mitigate that risk also. It is not about the risk, because risk will be always there. It is all about how do you manage that risk, because nobody has made big money without taking risk. So we have to take that risk, and we should be able to manage that risk. And the way to manage that, at a later stage, I'll be talking about that strategy. Now, one more thing is, even though small cap index has shown a trend change, valuations are not yet cheap. The slowdown has begun, and we have also seen just yesterday one of the news which is coming out from PLI, that PLI will not be extended to more sectors. Some of the sectors which are getting highly benefited are electronic manufacturing segment and all those, but it cannot be implemented on a larger scale. We have not seen even after the implementation of PLI, the share of manufacturing in the total GDP has not gone up. In fact, it has dropped. So for some sectors like electronic manufacturing, it has been a boon, but for other sectors, it has not done anything good. So that lag effect is already there, and the slowdown can hit go small caps going forward too, and that is what the situation is. So, however, selective small caps, because we cannot paint everything with the same brush. There are selective small caps which are at heavily mouth-watering levels. So, stock specific markets and stock specific rallies can continue, but you have to be very confident that in 3 years the revenues can double and profitability can go up 2 to 3 times. Only such stocks can be said as stock specifics, high conviction small caps. So that with such opportunities, the story is different. But when overall sentiments is bad, they can get hit too. But you should not miss such companies. Why? Because uh, just if sometimes what happens, sometimes they might start outperforming, and whenever the bull run start, they might move up 30, 40, 50% within a month, and it might be difficult for you to make a comeback. So highly selective small caps can still be owned. It might be in mid cap also, small and mid caps, whatever, which are highly selective, where you are heavily confident that in next 3 years the revenues can double. Understand this criteria: 3 years revenue doubling and profitability can go up 2 to 3 times. If that is there, plus low starting valuations, if these three things match in any small and mid cap, you should not worry about the markets, because the stocks can fall down, but you should not be worried. So in all, if we get a mix of all these three based on the market outlook, a combination of BFSI, more on financial services side, precious metals and their miners, Chinese equities, and some commodity stocks, plus heavily undervalued small caps where a revenue doubling is possible. So such, if we create a mix of all, we'll be mitigating the risk in a big way, even in this market. It is all about there will be always the risk, as I said. It has to be how do we manage that risk, and this is what the market outlook is. Now let us look at from the data why I'm saying so. First, I said it in September also. Large caps are placed better than small and mid caps. Even today, that is the situation. So what has happened is, small cap index is still trading below 200-day exponential moving average, but Nifty has already moved above 200-day exponential moving average. So it is trading at a much better situation than small and mid caps. And even from a valuation perspective, if you look at Nifty, because I'm not looking at price to earning, uh, I'm looking at, please put your camera down, everyone. Just give me one. I'm looking at price to book, because that is a good representation of valuations, because earnings can be erratic, but the assets cannot be erratic. They get updated once in a month. And once in a year, and that is what can give you a better situation. Once in quarter they get updated, price to book. So the valuations are now near fair. I will not say more undervalued, but now near fair. And as on 2025, Nifty benchmark index exhibited following metrics on consolidated earning, price to earning 21.4, price to book 3.5 times, and dividend yield is 1.3 times. From a price point of view, they are placed better than small and mid caps. Now let us look at one more thing but Nifty is not a true representation of Indian market sentiments. If we have to look at clear Indian market sentiments, we have to look at Nifty 500 index. So Nifty 500 index, the valuations have started becoming fair, but cycle is against. So why I'm saying that cycle is against, just look at this data. So this is Nifty 500, CNX 500 to Nifty ratio chart, which means CNX 500, which is a true barometer of broader markets in India, which truly represents the Indian markets. Whenever that ratio starts falling down, we have seen in past that there has been an underperformance of at least 2 years. So let us say if the underperformance has started just last year, there is a possibility that for some time we will see this underperformance. But also there is a chance because it has touched this support line. If you can see here, this is blue line, which has touched the support line. There might be a chance. So going forward, we might see that bounce coming. But as of now, this picture is not yet true. Picture is not yet clear. As of now, we are getting a sense that broader market underperformance should continue for some time. So what is this overall situation telling us? That valuations have started becoming fair, but the cycle is against. Time correction is imminent, suggesting the mix of lump sum and SIP plus STP. Usually, whenever you have seen me, wherever the starting valuations are low and the markets are highly favorable, that is the time I say that this is the best place to be. But this is currently the overall the at least till the end of this calendar year, it is likely that we have to go on a slow accumulation mode, a mix of lump sum plus slow accumulation mode. That is what will help us mitigate the risk and help us also get better averages. That is what the strategy should be. Now let us go at one more index, that is Nifty Financial Services Index. So Nifty Financial Services Index is now just near COVID valuations. If you just look at this price to book, so Nifty Financial Services Index in COVID times, it touched a low of 2.4 times. 2.4 times. Currently, it is trading at 2.8 times. So slightly above the COVID valuations. But from a price point of view, this is from a price to earning point of view. From a price to earning point of view, it is trading way below even the COVID valuations. That is Financial Services Index. Also, profits for the Financial Services Index has moved ahead than the index prices. If you see here earlier, what happened is prices move ahead than the earnings, and ultimately earning catched up, prices fell down. Once again, they moved together hand in hand. And if you see prior to this in 2018, the prices are moved ahead than the earnings, but currently earnings have moved ahead than the prices. What it means is earnings have to catch up. Prices have to catch up with the earnings. So that is giving a source of margin of safety in banking and financial services. Also, one more thing, why I'm saying that small caps are not the best place to be is because of this small cap versus Nifty ratio chart. And this ratio chart usually tells us the best time to buy small caps in truckload. So whenever the ratio hits 0.5 times, that is the best time to truckload the small caps. As of now, you may be seeing here that from 2004 to 2008, small cap gave higher return than the Nifty, but from 2008 to 2010, it lost all the returns which it made it in past cycles. So it lost all the alpha. Once again, it created that alpha in 4 years and it lost all that alpha in 2 years. Once again, it created that alpha in 4 years. Now the alpha losing stage has already started. There is a high possibility that small caps might remain underperformer because it has just crossed that blue line now. Well, even though the index has shown the trend change, this number has to be highly favorable to go gung on small caps. Today, the situation is not good to go gung on small caps, even from a valuation perspective, even from a chartical perspective, even from a economic perspective, even from all those perspective. I think small cap is still not the best place to be. Maybe after once we see let us say 2 3 months down the line, when the more results come in, we get more clarity, then we can review about it. But as of now, as on this stage, at current stage, small caps are not the best place to be. And historically, it has given the best entry points at 0.5 times ratio. So if you see here, if you really want to load up the small caps in a big way, 2004 was the best time to, you might have created 100% small cap portfolio. 2008, 9, 100% small cap portfolio you would have created and still made big money. 2013, 100% small cap if you would have created, you would have made big money. 2020, if you have created 100% small cap portfolio, you would have made big money. And even in March 2023. But today, the situation is not that. Maybe in 6 8 months down the line, that situation might come wherever you might, you even if you put money in any random small cap, you might still make money over the next 2 years. That situation is not yet come. So once again, I'm repeating it. Even though the small caps have shown the trend change on indices, it is good for stock specific buying, but not going gung on small cap at this point of time is very much important, because a lot of investors, even if we have seen in the recent mutual funds, a lot of people are still doing heavy SIPs and heavy investments into small cap. That shouldn't be done, because just because markets have corrected, it doesn't mean all the indices gives you a same level of opportunity. Small caps are not yet favorable. That is what I'm saying. First of all, equity itself is not favorable. And within that, small caps are not favorable. So that is what the equation is today. So we have to strategize it accordingly. This is Bloomberg. This is Thomson Reuters Commodity Index. So Thomson Reuters Commodity Index is at a cup and handle level. The commodity bull run has started last year in April. We are already in a commodity bull run. And we might see that bull run going continuing, because even in the recent times, whenever the correction happened in this commodity index, the correction was short-lived. Once again, it started making a new high. So what it says is this precious metal bull run will continue. We don't have to worry about precious metal bull run. Gold might see a sideways move, but silver is placed better than gold. Then comes industrials. In some of the industrials have already started moving up, industrial commodities. So that is what the situation is. Now, one more thing, outlook, which I said, Chinese equities are better placed than Indian equities. Why I'm saying so? It is because of this chart. If you can look at this chart, this is CSI 300 index. This is broader markets, Chinese broader markets. I'm bullish more on tech side of China, but when we are looking at China, because money cannot only come in Chinese tech industries, it will come overall in Chinese mutual funds or Chinese stocks. But within that, tech is expected to do well than broader market. That is what my reading is, and I'm bullish on that. And in fact, I'm more bullish on Hang Seng Tech ETF, Hang Seng Tech Index. But when we are looking at allocating to China, we should look at this data, overall broader index, what China looks like. So CSI 300 index is the broader Chinese index. It has just started its outperformance against Nifty, and valuations are heavily attractive. So if you see here, this is lower high, lower low, because even prior to this, there was a high made and it was a lower high. And after that, there was a new high made, which was a lower high. So lower high, lower low, lower high, lower low, lower high, lower low. As long as it is continuing, it is showing us the downtrend. And this is Chinese 300 index versus Nifty, which means Chinese index was heavily underperforming the Nifty. But what happened is, since last year, maybe somewhere near April, that trend of downtrend started to end. Then it went sideways. And for the first time in October, it made a higher high. If you see here, from lower low, it made a higher high, then it made a lower high, higher low. because if you see here, this low is higher than the earlier lows. And once again, it made a higher high. So earlier higher high was because this was the earlier high and it crossed that high and it made a new high. So it was a higher high. Consecutive for the second time, we have seen higher high. We might see some softness in Chinese equity in short term, but once again, the Chinese equity might will start outperforming Indian indexes. And why I'm attracted toward Chinese index is because CSI 300 index, which tracks 300 major A-share stocks listed on Shanghai and Shenzhen exchanges, have have these valuations. First of all, price to earning in 13.32 against Nifty, which is trading at, even on standalone, which is trading at 21 times on and consolidated is trading at 21 times, and standalone it is trading at 24 times. Just see level of undervaluation which is available in Chinese equities. Price to book is 1.32. In India, it is 3.5 times. Some might argue that some might say that a lot of Chinese companies have diluted their equities. But one more data point which we need to understand: government is giving a stimulus in that way that Chinese companies can buy back their shares. If Chinese companies are buying back their shares, Chinese government will be providing an additional incentive for the companies, which means whatever they have diluted more over the past 5-10 years, that dilution can get reversed because of these buybacks. So both these things need to be looked at, and from that all angle, it is giving me a holistic analysis that Chinese markets will outperform the Indian markets. But there is one more problem with China is because just because you are seeing this data that Chinese markets will outperform the Indian equities, you cannot go gung ho on China. The reason for that is China is opaque. It is not as transparent as India. So we cannot go big in China. It has the allocation should be limited, just like what we are going with any sector funds. So that should be taken care and allocation should be adjusted accordingly. So that this is the data which is telling me that Chinese index will outperform Nifty. One more thing, why I'm saying that silver is placed better in the current precious metal bull market. This is told by this data. I've discussed this in detail in silver session. You can go through that. But what this data from DSP says that by now silver should have traded above $51 to $70. Forget about $70. Even taking $51, which means 50% higher than the current price. Gold has already started trading above 3,100, and silver by now should have traded above $51. So silver is deeply undervalued. So combining fundamentals and technicals, because technically silver is at a stage where it is showing a rounding bottom breakout. It might happen at any point of time in coming weeks or coming months, but there is a high possibility and probability that silver will break out this from this range. And if it breaks out, there is minimum upside, which is 50%. So combining fundamentals and technicals both, I'm getting a sense that can silver price touch 1.5 lakh rupees? That is what the fundamentals and technicals overall is telling. Currently, it is trading at 1 lakh 1,000. So are we going to see that phase? So along with that, I've also shared one more data. I think if I have that data, I'll just look at that. Silver is better placed compared to Indian small caps. I'll just show you that data also. This is Indian small caps in dollar terms divided by small cap. Silver divided by silver in dollar terms divided by small cap. So what this data is saying, and this has just given a trend change upward breakout. This ratio chart has given a trend change upward breakout. What it says is silver is placed better compared to Indian small caps. That is what the data is saying. So overall, from entire thing, as I discussed the outlook. So from all this data, it is quite evident with whatever market outlook which we have shared. Hope you all got the insights about the market outlook. From all those data points, we have come up with this market outlook. Banking and financial services, precious metal, Chinese equities, commodity bull run, equity as an asset class itself is unfavorable. Small caps are not yet cheap. So looking at this whole market outlook, this is how we are playing the strategy over the next 1 year. So with our clients which who are invested with us, this is how we are playing the overall strategy for next 1 year. So this is first deep value portfolio. As I said, that selective small cap stocks, deeply undervalued stocks. This is how we are allocating. That is 52% of the total allocation. The strategy is 50% lump sum, 50% through staggered buying over the next 6 months. Then next is DSP, Banking and Financial Services Fund, overall 16% allocation, 50% lump sum, 50% through weekly SIP or STP for 6 to 9 months. Edelweiss Greater China Fund, overall 16% allocation, 50% through lump sum, 50% through weekly STP for the next 6 months. Nippon India Silver ETF FOF, 16% allocation, 50% through lump sum and 50% through weekly accumulation for next 6 months. So this is the strategy which we are following for our clients. But please do not take this as a direct recommendation, because this is a model. But this model can change depending upon client's profile. Each person has a different profile, and accordingly we work on that profile and we create a strategy. But this is how the overall situation looks like. It cannot be exact. The exact can be having some changes in this depending upon the asset allocation, personal asset allocation strategy. And if I conclude that I have completed the entire presentation for this today's session, which is uh, market outlook for FY 2025 and 2026. And based on that market outlook, how do we strategize ourselves for the next 1 year? And this is how we are strategizing. If you liked our work and want to invest with us, you can connect with our handholding team. For capital above 3 crores, you can connect with Ganesh. For capital above 25 lakh, you can connect with Aditya. For capital below 20